I'm taking a look at Tesla, shares of which have obviously been under pressure this year, given Elon Musk's role in the government and the drop-off in Tesla sales that we've seen. But it's really notable that over the weekend we had Wedbush analyst Dan Ives come out with a somewhat stark note. He's possibly the best-known tech analyst and also a noted Tesla bull and a noted tech bull. And what he was saying is that Elon Musk should step back from his work at DOGE and refocus on Tesla full-time, given that the car maker is facing what he called a code red moment ahead of it reporting earnings later this week. What he said in the note is Musk needs to leave the government, take a major step back on DOGE, and get back to being CEO of Tesla full-time. Again, a noted bullish analyst on Tesla coming out with these stark words.
Here's a totally unfair question that you may not know, but that's okay. Is Elon Musk going to be on the call tomorrow?
Oh, I would be. Well, that's a great question.
Really great question.
I would think he would be, but I don't know.
I was going to say because Dan Ives' whole point is that he wants Musk back in the control seat.
Yes,
invisible. Saying that he just needs like that direction of the company.
Exactly.
And I'm just curious as to what that's going to wind up looking like. Anyway, you're also looking at Netflix. So again, we were talking about this in the last hour. This feels a little macro-proof in some respects.
A little bit. We have shares of Netflix up some 3% today, and that's after it reported earnings at the end of last week, right before the holiday. And I think the earnings surprised analysts in a positive way for once.
Yep.
So we actually have shares of Netflix up more than 10% year to date. Obviously, the market is having a really, really tough year. So to have one of these big tech giants actually doing really well is a note of
unusual. Yep.
Exactly.
Yep.
And so we have Netflix shares rising. It forecasts revenue for the second quarter that beat the average analyst estimate. It reported record profit to start the year. So it's allaying some of those concerns of a potential slowdown among analysts, at least.
About Nvidia, which has been an AI darling, but not so much this year.
That's back to that basket of companies that aren't doing so well. So we have shares down more than 5% today alone, obviously hard hit year to date. Shares of Nvidia are trading at near their lowest valuation in this AI era that we've had over the last couple of years. And investors still seem to have some concerns about buying. They're being cautious about buying. Obviously, the list of concerns is long and growing, maybe we can say. So spending on AI could slow down given the escalating trade war. And then last week we had the company also saying that one of its chip lines, the U.S. Authorities have barred it from selling it in China, something that could cost the company billions of dollars. So
you know, it's funny. If you look at Nvidia versus Tesla on a price to earnings basis, so you have Nvidia still at 32 times, Tesla's still at 102.
Yep.
So like just even the re-rating, it's totally crazy. All right, Vildana, thank you very much. Vildana Heinrich joining us, Bloomberg News cross asset reporter.